I graduated from Oxford University in 1983, having read philosophy, politics and economics, and I started on the stock market with a stockbroking firm in that year. I moved into fund management in 1985 and I became the fund manager of City of London Investment Trust in 1991. So I've been fund manager for City of London for 32 years. I work in the global equity income team at Janus Henderson Investors. The objective is to grow shareholders' income and capital over the long term. The board also fully recognises the importance of income to shareholders, and in addition, we invest predominantly in shares listed on the London Stock Exchange. These are often global companies, but some 80% of the fund at least will be invested in shares listed on the London Stock Exchange. The fund's invested in equities, so we really generate the income from the dividends that the companies pay. So it is crucial to identify companies that can consistently pay and grow their dividends. So that's sort of a key part of the portfolio management. As an investment trust, we also have the ability to hold back some revenue in the good years and build up a revenue reserve. And so we can hold back up to 15% of the income, and then in the really difficult years for income, we can draw on that revenue reserve. So if you look at the first quarter in 2020, at the beginning of the pandemic, there was a huge amount of dividend cuts across the market, but we continued to grow our dividend by drawing on our revenue reserve. And that's how we've managed to grow our dividend every year since 1966, a mixture of our revenue reserve and having a core of consistent companies in the portfolio. The management fee is 0.325%, which is very low for an actively managed fund, and the actual ongoing charge, including admin, is 0.37%, which is the lowest in our sector. Yes, there's two investment processes. I would say philosophically got two sides to it. First of all, it's valuation driven, and in that I'm looking to buy shares at a reasonable valuation in terms of their future growth prospects. And I'm looking obviously at dividends, but I'm also looking at companies that are investing enough for their future. Dividends today are not enough. You need to be investing enough for the future, for future profits and dividend growth. And the second sort of feature of the style is that I'm quite a conservative person, and so the fund reflects my personality, and we favour companies which good cash generation, strong balance sheets. And I think a good example of that was a few years ago, some 7 or 8 years ago, we bought Morrisons Supermarket, which is obviously one of the UK's leading supermarket companies. What particularly attracted me was it was a reasonable valuation. People were worried at the time about the growth of Aldi and Lidl discounters, but also was a strong asset backing within the company. It had a particularly high ownership of freeholds of the supermarkets that it operates from, higher than its competitors. And it also sourced a lot of its food from the UK. It's a good quality company, good cash generation. So all those features attracted to me. And actually it turned out to be a very good investment. Ultimately, it was fought over by two private equity groups and was taken over at a large premium to what we had originally paid for it.